Evening, everyone, and welcome to the Power Income Futures Day Trading course. Can I please have a quick sound check? If you could please type a 1 in the chat box if you can hear me, and also if you could see the shared screen, I would greatly appreciate it. Good afternoon, everyone. All right, let's get started. But before we begin, so welcome new students and also welcome retake students. As usual, we will begin right now, and we will be taking a quick 15-minute break at 7 o'clock, from 7 o'clock to 7:15. And we will wrap up around 8:15 or 8:30, depending on the number of questions that I'm going to be getting at the end. All right, so I just want to make sure that we address all the questions that are going to be answered. All right, everyone, let's get started. My favorite part, Power Income Futures Day Trading. And you guys also have access to the swing trading course. The recording of the swing trading course was emailed to you. Also, the manual will be emailed to you at the end of the week, because we want to make sure that you guys follow along. So I don't want you just going to the manual back and forth. So this is the manual actually, but you will see that I will make a lot of comments based on each and every single slide. We're going to drag some charts. So everything is real time based on current market environment. So, and again, if you have any questions, feel free to post them into the chat box and I will address them as we go along. All right, before we begin, let's read the risk disclaimer. So basically, all the information provided by Trade Out Loud is for educational purpose only and should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, or any other instrument of any kind. Trading involves a high level of risk and may not be suitable for all investors. You could lose money. So before deciding to trade, you should carefully consider your objectives, your level of experience, and your risk appetite. Individual performance depends upon each person's skills, time commitment, and effort. Results may not be typical, and individual results will vary. You must do your own research and make your own trading decisions. Past results are not indicative of future returns, and Trade Out Loud LLC websites and its subsidiaries and all affiliated individuals assume no responsibilities for your trading and investment results. We're not registered nor licensed, so if you feel the need to seek advice, the only person that you can address those inquiries are your financial planner, advisor, or broker. All right, guys, let's get started. Today, we will be talking about candlesticks and charting, candlestick language, patterns, and candlestick formations. New students, I think that you had the time, and I hope that you had the time to go through the introduction to futures. I will pass along through those slides, and if there are any questions, feel free to ask in the room, and I would stop at that specific slide and provide extra explanation. I want today to dedicate, and today is such a great time to talk about candlesticks because, you know, a lot of time we have like really messy patterns that are not really, and where the candles are a little bit confusing because the areas where they are. But right now, things are looking so great for our charts, right? Just one quick visual. Just let me know if everyone can see the slides, okay? Because I'm not displaying. Okay, perfect, Denise. Thank you so much. I'm not displaying. Usually, Zoom has a colored frame, and I'm not getting that frame. So I just want to make sure that it's on the charts. I'm sorry, that it's on that the projector is on the slide and not on the charts. Okay, because I have my platform up. Okay, so again, today is going to be a fantastic day to go over candlesticks and candlestick patterns. And it's gonna provide us a great opportunity to review the swing that we basically have initiated today. Also, we will be talking about charting tools and indicators that we're gonna be using for our day-to-day trading. We're going to continue with the 4 market stages. Not really sure that we're going to complete the 4 market stages. We're going to do our best. We have a lot of information that we have to capture within these 5 days. These 4 stages refer to the optimum time for buying or shorting, the optimum time when to exit long positions or short positions, whether we are in a day trade or a swing trade, and the optimum timing just to sit on our hands. Because remember, cash is a position. We're also going to be talking about market trends, characteristics of an uptrending market, of a downtrending market, of a sideways market, and when and how to trade in each market, whether it's up, down, or sideways. Day trading timeframes and analytical timeframes. This is going to tell us, based on our forecast that we're doing basically every day in the trading room, is going to tell us how and where the execution needs to be done on smaller timeframes. And obviously the small timeframes where we initiate those trades. We're going to talk about synchronicity and divergency. If you guys have been in the trading room, you're pretty much familiarized by now with the fact that every morning I look at the synchronicity or divergency between indices. Also, relative strength and weakness. This is also something that is in sync with synchronicity and divergency. So basically the chart, and this is very important here, basically the charts are, some charts basically are stronger than others. Even if we see, let's say, NASDAQ or Russell, we saw Russell today that had relative strength, right? And it was up 0.70%. It had a relative weak chart structure compared to all the other charts, compared to NASDAQ, compared to the S&P, okay? So even if the chart structure is strong, it could still have relative weakness overall, but more when we dig into that. Then we're gonna jump into advanced technical analysis. We're gonna talk about the 7-layer support resistance. We're going to talk about market reversal time, so the market tempo, because the market works on a systematic cycle. It goes up, and it has a time when it's prone to coming back down, and depending on how the pullback reacts, whether it's shallow or whether it's steep, and depending on which type of trend we're in, we can expect the market tempo to work better than anything else. Trigger times. There are specific trigger times throughout the New York trading session, obviously US session, that you hear me in the trading room saying it's 10 o'clock, it's reversal time, it's 10:30, it's time for something to line up. And oftentimes throughout the day, or you hear me talk about the 2 o'clock or the ramp, okay? This is all part of these of the trigger times. Then we're going to talk about the anatomy of the trade. You will learn how to precisely identify an entry, where to place the stops, how to calculate the targets, and trust me when I tell you this, it's not rocket science. And once we learn how to look at candlesticks and how to look at patterns, determining an entry, a stop, and determining targets are not going to be a big deal. It's all about how we recognize these pullback buys, these trigger zones. Also, how to calculate the risk. How many contracts are we going to get into that specific trade? Okay, with. So for instance, now that we have the micros, this gives us the opportunity to leg into some swing trades that were prohibitive in cost up to now, right? Would we be able to take an S&P trade long with a 40-point stop? No, of course not. But now through micros, we can, if that fits our trading plan. And I'm going to teach you how to do that. And obviously how to position size. We're also going to be talking about trading strategies, and we're going to go through multiple strategies, but just so you know, some are more refined, But basically, there are two basic strategies that you have to learn at the beginning. The rest, you can study along, okay? But for the beginner stage, I want you to master just these two strategies. And then you can add on, and then you can add on a little more. But if you learn how to master 1 to 2 strategies, and basically we're talking about a pullback buy or a pullback sell and a breakout or a breakdown, okay? These are basically the two strategies. Either you buy in an uptrend or you short in a downtrend, or you buy a base breakout in an uptrend, or you buy a base breakdown in a downtrend. And this is going to keep you always on the safe side. You're never going to be caught on the wrong side of the trade. Knowing when to go long or knowing when to go short is one of the most important things that we need to do. Also, based on chart patterns, I will teach you how to read the charts, starting with the largest time frame, zooming into the smallest time frame. And once you learn how to do it properly, from the higher time frame to the smaller time frame, it'll make more sense. And you're going to understand the dynamics of price action. Also, money management and risk management. These are two very, very important components of trading. We're going to tap onto a little bit about into trading psychology, and then we're going to be putting everything together in the trading room. Now, I know some of you guys have been in the trading room for some time. You really like what we're doing in the trading room, so you guys signed up for the class. It's going to make so much sense when even after today's chapters that we're going to go through, tomorrow is going to have a whole new meaning, I promise you. And I want your feedback on that, okay? All right. Now, you received the recording with the introduction to futures. And basically, in here, we talked about what futures are, who trades futures, why trade futures. But now, more so, we have the micro. So, again, we have another very important element that actually gives us another reason to trade futures. We talked about the contract. What is futures trading? What can we trade, right? Because we're focusing on the indices, but don't forget that we still have, and I'm going to go very quickly through it, we still have a whole panel that we can trade. We can trade currencies. We can trade bonds. We can trade metals, platinum, besides gold, silver, etc. Okay? We just need to find a pattern in those specific commodities or bonds. Rollover. Now, last Friday, so basically it happened on Thursday night, right? Every quarter, future indices roll, okay? So I gave a lot of explanation into that chapter, but if you need extra explanation today, and I will highlight a little bit because the roll just happened, okay? Then we could talk about what happens into the roll. So how does price behave going into the roll, and how does price behave after the roll? And also trading hours and symbols, okay? So I'm gonna skip the part with what futures are. You guys have reviewed the recordings, okay? So let me know if you need any extra explanation as we're fast forwarding through these slides right here. These were from the video. So basically you can trade agricultural products. We can trade energy, like natural gas, right? Heating oil. We can trade equities, which is the bread and butter. Why do you think this is the bread and butter? Because it has the most volume, okay? It is the most traded. And therefore, when you're day trading, you have to make sure that you're trading something that is liquid, that has a lot of market participation. If it doesn't have a lot of market participation, odds are that specific index or commodity or whatever you may be trading is not going to fluctuate, right? And not only that, but it's going to have a spread. It's going to be spread. It's going to have a spread, right? The difference between the bid and the ask, and therefore you can get filled out at random numbers. Also, interest rates. We tapped on today into the trading room. Bonds have been basing, which is normal. It's normal to see the bonds range and the indices range going into this FOMC meeting, because this FOMC meeting is a big deal, right? Are we going to get a rate cut? Are we not going to get a rate cut? You can see that financials are very sideways. The S&P, which is financial rich, is pretty sideways at this point. So take a look at it today. So for instance, today in the morning session, it was trading at around 28.98. It's still there right now. It's still trading within that range. You can trade metals, okay? Gold, like I said, gold, silver, platinum, palladium, etc., copper. So there's a plethora of metals that we can trade. Forex, that is currencies. We can trade the dollar, we can trade the pound, we can trade currency pairs such as Aussie dollar, etc. So we can do everything with futures, and it gives us a great flexibility. And I think it's the best market. And this is coming from me, that I was a complete stock addict, and I wanted to simplify my life in the sense that I didn't want to scan every single day through literally hundreds and hundreds and hundreds of stocks before trying to find a day trade. And that one common denominator was what? Was the market indices. So no matter what I was doing and what stock I was trading, I was always comparing it to one of the market indices and to all the market indices. So throughout my trading career, the one constant that I looked at every single day and every time of the day were the indices. Back then, when I was only trading stocks, I was looking at the Qs, the SPYs, the diamonds. That's it. And then I was trying to have a selection criteria for my stocks based on what the indices are doing. I was trying to find relative strong stocks or relative weak stocks, because I wanted them, obviously in a strong market, the relative strength stocks have the power to push through faster than the weak ones. And in a weak market environment, you're going to go for the very, very weak stocks. So that one common denominator were the future indices. And that's what I love about them, because it's trading in a simplified manner. And now that we have the micros that have been introduced about a month and 2 weeks or so, a month and a half, let's say, now we have the flexibility to position size better and to participate. We have the luxury to participate in swing trades. We have the luxury to layer in and layer out and to play as if we're trading with shares. Okay, so futures are standardized contracts for the purchase and sale of financial instruments or physical commodities for future delivery on a regulated commodity futures exchange. Okay, then we talk about the forward contract. If there are any questions, let me know. Pretty spot on, I would say. Okay, spot market is the market where cash transactions for physical or actual commodity occur. Okay, Globex is the first global electronic trading system for futures and options that has evolved to become the world's premier marketplace for derivative trading. It's in Chicago. All right, and then we talk about who trades futures, right? Because futures have so much interest. In 2015, in December of 2015, Morgan Stanley, Chase, and Goldman Sachs allocated more futures traders to their futures desks. So the volume has increased substantially since then. It was a very liquid market until then, but I saw a jump in market volume beginning with December 2015. Hedgers participate in trading futures. Individual traders just like ourselves, portfolio managers, proprietary trading firms, and I'm not talking about proprietary trading firms like Top Step Trader or what have you that provide funding for accounts. I mean the big proprietary trading firms that allocate you millions of dollars to trade. millions and millions of dollars to trade. In fact, we are going, we're working on a, let's say, agreement with a big proprietary firm. I'm just dealing with them right now. And if there are any traders amongst you that want to trade a bigger size account, and I mean big size account, you can do so. I'm not going to tell you yet what firm it is, but it's a big proprietary firm. And funny enough, they have their proprietary firm in Boca Raton, Florida. So I found that out down the line. So it was like, what? And they're like very close to where I live. And that is an office, again, that is a professional, institutional, proprietary trading company. Okay, so they're not advertising, they're not doing anything. So if any one of you decides down the line to trade someone else's funds, and I'm talking about 500,000 and up, $1 million, $1.5 million. So we will have we will have some conditions for that. But if you decide to do that, you have to know that you have that avenue wide open. Okay, so you can definitely do that. Also, hedge funds. Okay, they trade futures. Market makers, they love futures. Who else loves trading futures? Algos. Algos love trading futures. In fact, algos love to trade futures indices, and they also love to trade ETFs. It is a known fact. It is a known fact. They're easier to program. ETFs don't have, if you're trading stocks, you have upgrades, you have downgrades, you have reports, you have earnings. How about ETFs? You do not have that. Okay. So because of that, they're more constant in price fluctuation. And because they're more constant, they're not going to gap up big, or they're not going to gap down big. Because when you're talking about an ETF, you're talking again about the Qs. Let's say you're talking about the Qs. Under the Qs, you have a whole plethora, 100 stocks. When you're trading the mini S&P 500, you have 500 stocks, right? So it's less likely that 500 stocks within an index are going to gap up or are going to gap down. So it's going to be a constant. Let's say tomorrow, or let's say after FOMC. Let's say after FOMC, let's say the Fed is going to cut the rates, and let's say that financials are not going to be very happy with that, right? Because that's where they get their money from. So let's say the financials are going to gap down. They're after FOMC, right? After everything is all said and done, let's say they're going to go lower. This is hypothetical, right? They're going to go lower. And let's say overnight, they're going to gap down big. Okay. So if you're trading the mini S&P may go down. So, or if you're trading the SPY or SPX, it will go down, but it's not going to plummet. It's not going to plummet, let's say, like the XLF, or it's not going to plummet as an individual stock like Goldman Sachs or Bank of America, right? Because it's only a sector within the whole index, right? So you can see why the algos prefer to trade the indices, right? Or to trade the ETFs. By the way, do you guys know which stock is the most algorithmic traded stock? Do you guys know? Have any idea? Like, we know that when we're talking about stocks, we talk about Goldman Sachs, JP Morgan, Wells Fargo. These are the go-to, right? Bank of America, et cetera, the go-to stocks, right? Do you guys know which one? Most heavily traded. Bank of America. It may sound surprising, but Bank of America is the #1 algorithmic traded stock. And they are going for very, very, very small size. In, out, in, out, in, out, in, out. Yeah, it's Bank of America. All right, so individual traders, this is us right here, portfolio managers, proprietary trading firms. Like I said, if you guys are going to be interested down the line, we will make an announcement. I don't know if we're going to make a public announcement, but there are going to be some requirements for you to trade those funds. But just wanted to let you know, guys, we will have an open offer, and we have a great avenue for proprietary trading. Okay, hedge funds, market makers, and algorithmic trading, right? I want to spend a little bit more time here with algorithmic trading, because algorithmic trading is known as automatic trading, black box trading, or simply algo trading, right? So it is the process of using computers programmed to follow a defined set of instructions for placing a trade in order to generate profits at the speed and frequency that is impossible for the human trader. The perfect example we had last week in that YM trade, right? In the Dow trade, where it opened, it snapped right to target 1 and target 2, and immediately it came in so fast. Like you literally had to have the orders, the take profit orders in. Other than that, it was not humanly possible to go to your mouse, look where the price is on the dome, click there, take profit. It was very, very fast. It happens almost in a nanosecond. So the defined set of rules are based on, and hear me out, timing, right? What are we going to discuss in this class? We're going to discuss market timing. We're going to discuss the market tempo. So the timing, the execution time is very important, because these algos love to begin right at the US Open. There are tons of algos, don't get me wrong, tons of algos that are into the London session. And by the way, do you guys know which market has the most algos? I'm going to ask you guys. Type 1 if you think the stock market. Type 2 if you think it's the futures market. And type 3 if you think it's the Forex market. Which market do you guys think that is the most algorithmic traded market? Come on, guys. Which ones do you think? Okay, so Denise, you think the futures market? Okay. No, it is the Forex market. The Forex market is the highest algorithmic traded market. Exactly, Kim. It's the Forex market. The second market after the Forex market is the futures market. We have had an influx of Forex traders into the futures market, because the Forex market has become extremely whippy. And you can trade futures, and you could trade currencies via futures. So it offers you it offers you the possibility to still trade currencies or even a currency pair, but not be whipped in or whipped out as in Forex trading. I have traded Forex for about 12 years, like actively trading Forex. And I loved it. Okay, I loved it, but it has become extremely volatile, very, very volatile. Central bank, it's basically when you're trading Forex, you're trading exchange rates. That's what it is. And there's heavy manipulation every single day. So it's, from my perspective, it's not a difficult market, but it is a heavy, it is a very whippy market and a heavy manipulated market, okay? And it's more, you know, at certain points, at certain inflection points on charts, it's more of a guessing game than anything else. It was not always like this. But now with the presence of algos and more algos and more algos, that's what this is what it becomes. Also, about 2 years ago, excuse me, so that was in 2017. In September 2017, okay, here's what happened. The summertime has started off really well, and then all of a sudden, we had an extreme whip in the futures market. Now, let me tell you guys something. These programmers that are setting these algorithms constantly change parameters. One day they let's say not one day, but let's say for a period of time, that may be for 6 months or 8 months, they are programming these algos to react, let's say, off the 10 EMA. In some cases, they switch and they love to set up these algos from fib lines. In some instances, they like to trade off the 20 SMA. And this 20 SMA has been a constant. Okay, pullbacks to the 20 SMA have been constant. Lately, and I'm talking about less than 1 year, they have, and I have noticed this, and again, we're gonna go through charts, and I'm gonna show you on the chart how it looks like. Weekly charts. Weekly charts have been in play, and price has been reacting off of these moving averages that we're gonna learn about in the next chapter, following the obviously the charting chapter. So you can see a pullback right into a moving average on a weekly chart. Watch it on smaller time frame, because when the price is reaching that moving average on the weekly chart, immediately look on a 15-minute chart or a 5-minute chart, because if you're getting a 5, 15, or even an hour rotation that is happening off of that weekly support zone, which is a dynamic support zone, you're going to get a reversal. Okay. All right. So we were talking about timing, right? There's a certain tempo in the market. Price is very important. I'm going to teach you here 4 price points where it will become a no-brainer to establish targets at. It's going to be super easy. This is all about simplifying your trading. Okay. Simplifying your trading. So certain prices, there are 4 price points. They're called fulcrums, and institutional traders use them. Because institutional traders use them, you are going to see their reaction. The fact that right now, where the indices are, they're trading into these fulcrums. So I'm looking at the M&E S&P, right? Which, if you're looking at the overall market structure, right, which is the most representative index? S&P 500, because it has 500 stocks under it, right? So it's a better representation than the Dow, and definitely a better representation than NASDAQ. So therefore, the M&E S&P or the SPX or the SPYs, right? If you're trading the SPYs, they love to react into these fulcrum numbers. Okay. Quantity. Okay. Quantity is also very important to algos, right? Because they go with billions of shares or millions or hundreds and thousands of contracts. And what they do, they don't push the button at a certain price. They're not like us and say, I want it here. Let's say I want the S&P over 2912. I want the stop, let's say under 2,900, right? And they just run with it. You have, when you're trading big size, remember the the proprietary trading company that has an office in Boca Raton. When they're trading, they don't get into that position at that exact price. They layer in, they scale in. And when they exit, they scale out. Okay. So they don't go just all in. Can you imagine how that would be if they would get all in at 2,900? It would be crazy. But no, they're buying at 2,900, at 2,900.50, 2,900.75, 2,901, and so on. every tick of the way they're legging in. Okay, and they're doing it in increments. All right, so that's the quantity part. Algos trade huge quantity, huge quantity. When they are layering out of their position, this is why you see those bottoming tails and then zip back up. Or when you see the topping tails, right? They scaled out, right? And then they came back in. All right. So there are certain ways to recognize these elements on the charts. Okay. So apart from profit opportunities for the trader, algo trading makes market more liquid and makes trading more systematic by ruling out emotional human impact on trading activities. We talked about this today in the trading room. I don't know how many of you guys were in the trading room, but for instance, right, we had a trade. We stopped out of the trade last week. How easy it, and basically was a shakeout, was an algo shakeout that pulled the price in, right? And then it rotated back up and jumped back up again. Very frustrating for the human trader, because I find it very difficult after I'm stopped out, because I'm human, right? I find it very difficult when I stopped out to get back in at the same price. But this is what we need to do. But as humans, sometimes we hesitate and we go like, okay, let's just wait for another setup. Okay, maybe this was not it. Maybe this was not a shakeout. So we wait for another setup. Where these algos, they don't think, they execute. Don't think that algorithms don't stop out of trades. They do. They stop out of a lot of trades. In fact, algorithms have the worst batting average ever. But because they do so much trading, and of course their commissions are very, very cheap, very, very cheap. It's not like, you know, for retail traders. They can afford to stop out, get back in, stop out, get back in. Okay. So algo trading provides the following benefits. Why I'm reading this is because we need to be and behave like algos. Trades executed at best possible prices, instant and accurate trade order placement, right? Hereby high chances of execution at desired levels. Sometimes the price moves so fast, and sometimes I go on the chart, and when I put my cursor, let me just pull the chart right here. Just give me a 1 here if you guys see the chart. Just want to make sure that everything is okay. Okay. So you can see here, I'm going to go to a 2-minute, let's say. All right, and let's scroll back here. Okay. Now let's say we want to get in. Sometimes the price moves so fast, we're not able to get in the trade, because they are already pushing the price either higher or lower. So when you take your mouse, our job as traders is to go on each and every single setup. I'm not saying that this is a valid setup for a long. I'm just using this as an example. So when you're trading the 2-minute time frame in a rapid market environment, not only that, you have to think in a nanosecond, right? That's why it is very important for us to establish the bias right from the very early hours before the US market even opens, so we know which way we're going to take, which way is the path of least resistance or least support for price, because that is the direction that is going to move into. So when I take my cursor and when I look and say, okay, I have to see where the high is. The high is 2894.5 and the low is 2893.75. By the time I read this, which is super fast because it only takes me probably like 10 seconds, right, to take the cursor and to see where the numbers are and to look at the pattern and to see where my possible reward is, the price is long gone. The price is long gone. Very, very fast price action. Okay, very fast. All right. Also, trades time correctly and instantly to avoid significant price changes. If not once, but a lot of times I ask you guys in the room, what price did you get filled at? Okay, what price did you get? Because and this is the number one reason why we switched from Webinaro to the Zoom room, because this Zoom room is bam, it's instant. Like you hear me talk, there's no delay. Okay, no delay. It's the same thing as talking over the phone. It has no delay. It's instant. The Webinaro room had like a 10-second, even at times, even 20-second delay. That's huge when you're talking about volatile markets. It's crazy, okay? The advantage of algorithmic trading is that it has reduced transaction costs, but also if you're a day trader, you can negotiate a better commission rate with your broker. The more you trade, the less expensive it is going to be for you to trade, to use their platform, to use obviously their commissions, etc. Simultaneous automatic checks on multiple market conditions. What I do every day in the trading room, and I keep tab on markets. I keep tab, let's see what the financial market is doing, because they're all in sync, right? That we need to have everything moving in orderly fashion, either higher or lower, right? We need to see a very nice chain reaction within time frames, and we want to see the tech up. We want to see, I don't know, services up, right? In order to take a trade in NASDAQ. That's why I constantly look. Not that I would day trade Apple, or I constantly trade Apple, or I look at Apple just because I like to look at Apple. No, I look at these markets because I want to have an idea of what the tech sector is doing, what the semiconductors are doing, sector is doing, and so on, services, etc. Amazon, you name it. I look at Amazon. These are big components that we need to watch every single time when we're trading the market. Reduce risk of manual errors in placing the trades, right? Reduced errors. Sometimes, and one of the biggest errors that I find with beginner traders is that we take a day trade, we take a swing trade, or we take a day trade. If we want to carry that specific trade overnight, you have to check one little single thing on your platform before your stop disappears. That's good till cancel. You have a day order and good till cancel. If you're holding the trade in the evening hours, you have to switch to good till cancel. Okay? A lot of traders make this, it's not a mistake. It's just that, you get so preoccupied with reading charts and etc., you forget to flip that. Reduce possibility of mistakes by human traders based on emotional and psychological factors, right? When we feel down, when we're sad, I don't know, when something is happening, or even sad, or when we're extra happy, right? We have to take a little break from the market, because that is going to transpire into our actions. We may be more exuberant and we may want to risk more if we're overly happy. I don't know. Let's say you have a job, you get a raise at work and you're super happy. You go like, oh yes, I'm going to get in with 10 contracts, right? No. Or if you're sad, you're just in front of the computer and let's say you see a trade and you probably misread time frames, or, there are a lot of things that can happen, and then you shouldn't be trading at all. If you have a fight with your neighbor, or if your neighbor parked on your grass, for instance, and if you have a fight with your neighbor, don't get back into the house and into the office and start putting a trade on, because you're going to put on an emotional trade. Okay, so that's not good. Maximizing capital efficiency, you guys know that. You guys know the value, and you've seen this in the videos, okay? New traders and retakes as well. The contract size, the contract value. We're going to get very quickly through this. Okay, the size. Now we have micros, and besides, you know, the regular contract, which is phenomenal. Okay. And one important thing is that, remember the expiration date. Every futures contract has an expiration date. You do not have to hold until it expires. You can sell at any time. Day traders only hold their position contracts for a few minutes to a few hours, depending on market conditions. So you don't have to be concerned about the expiration date. However, the expiration date is going to influence price action, and price action is acting a little bit more hawkish as it's going into its expiration, into the roll and into the expiration. So the nearer to expiration, contracts are usually more liquid. There are more traders trading them, so you're going to see a big shift in volume. There was something on Friday that drew my attention, and it was the fact that usually when the roll occurs, there's more volume into the upcoming, the fourth contract than they are into the contract that is going to expire, where it was the other way around. Okay, the other way around. Prices are more true to, prices are obviously more true and less likely to jump from one extreme to another. And they're going to pretty much stay in balance. You've noticed the balance into today's trading session as well. But that's not the only reason. The real reason is that FOMC meeting that is going to take place on Wednesday. And there is no limit to the number of contracts that you can trade. Okay, no limit. All right, we've been talking about what to trade and what to day trade. Like I said, for me, it is very easy to focus on these four indices: the Dow, the S&P, NASDAQ, and Russell. It's very easy for me to focus on them because we have great market participation and they are our go-to. Okay, they are our go-to. We can trade Nikkei, Euro stocks, DAX, VIX. Oh my gosh, this is super crazy. Don't even go near it. Okay. VIX futures. We also trade the VIX in shares, right? So gosh, I'm losing my stuttering here. Okay, so we trade it through shares, right? We don't use we don't use the futures VIX because the size and it's incredibly wide. It's very risky. You can't lose a lot of money by trading the VIX futures. So we trade the shares and we use the VXX. Okay, we use the VXX, and that makes more sense, right? Because you can position size and you can scale in or scale out. Okay, scale in or scale out. I actually typed in the VIX to see how to show you the VIX here. Okay, and it's basically easier to trade the VIX, and it's also a form of protecting for let's say, for instance, for now, right? We're in S&P long as a swing today, and what we want is for the S&P to go up. If the market structure is going to change tomorrow or going into Thursday, going into Wednesday, we may initiate a protection in the VIX, right? Which is hedging. We're hedging, we're protecting our portfolio. Why? Because we are still active in S&P and we're not going to sell it, right? Because we have a firm stop, and if the stop still holds but is ways down, right? We want to make sure that if we have an inverse chart pattern, and if the VIX are going to try to push higher, it means that the market is going to go lower. So what that means is that we are going to start building a position in the VIX. Okay, we're going to start building up if that should happen. What that will do for our portfolio is that it's going to balance it out, right? So even if the mini S&P is going to come very close to the stop level, right? But if, and obviously the account and the P&L is going to go down, we initiate a position in the VIX that is going to lift our P&L up, and then it's going to balance it, okay? So S&P long, right? We're S&P long. If S&P goes down, right, we're going to buy the VIX, okay? We're going to buy the VIX. All right, and especially, this is a great technique. All right, this is a great technique if you're trading stocks as well. Okay, we talked about energy. We can trade crude oil. We can trade Brent. We can trade RBOB, which is gasoline, heating oil. Okay, natural gas, ethanol, etc. Now, these are not, crude oil has a little bit more volume than other energy commodities. The other energy commodities do not carry a lot of volume, okay, for day trading, for instance. And you may get whipped around. You have to have like a wider, bigger account size. Now, if you want to trade natural gas, there's a mini natural gas, and you can trade it through that, which is more advisable. You can position size, it provides you more flexibility, because natural gas, believe me when I tell you this, I mean, some of you guys may have already traded natural gas. You could be up or down $3,000 to $5,000 like nothing with one contract. So that's going to put you in a totally emotional roller coaster. Okay, before you trade any of the commodities, I want you to paper trade them, to use a simulated account, so you have a feel, and trade just one contract to have a feel of how they move and how you can handle the move. And typically all of these commodities are better for swing trading, because in swing trading you do not have to have that big daily volume participation. When you're day trading, you have to make sure that you have a good balance of bid and ask, and that they're coming in super, super fast. You get filled at good prices. This way you're not going to get slipped on any position. You can also trade metals like gold, silver, platinum, copper, palladium, etc. Meats such as live cattle, feeder cattle, etc. Also bonds. We talked about bonds today in the trading room. If the bonds are going to start trading over that 155, the stop under 154, they're going to push higher. If you do not want to trade via futures, you could trade TLT. You could trade it via stock-like shares, right? TLT. Let me just bring it up. Okay, and you can position size better with this. So there are options that you can use, right? There are options that you can use. Okay, so this is the TLT, and it has a similar price pattern, right? You cannot trade it at night, obviously. One of the best things about futures trading is that you could have a good handle on your future indices or whatever you're trading 24/7. With stocks, you have to wait until the open, your trading session open, okay? And then you can see a gap up or a gap down, and that's, you can see how spready, and you have a lot of gaps here, okay? So this is the daily chart in TLT. Let me put the bonds. Look how liquid and pretty they are, okay? But if you want to trade the TLT, and I have traded, and sometimes I like to trade the TLT. Why? Because you can position size better. Okay, you can definitely position size better with TLT than you're trading the bonds. Okay, but we talked about the breakout level over 55 when we talked about the support under 153. Okay, all right, let's move this chart here. All right, greens. Now you saw that wheat and corn had a dynamic breakout higher. Okay, we traded a little bit wheat earlier this year. And then I was very hesitant because it could do some really whippy moves at night. And even if it was a swing trade, You really have to have a good handle on it. And it's subject to, and again, it's subject to a lot of things. Not only the weather, not only, you know, and we had a lot of bad weather. We had tornadoes, we had flooding. Okay. That's one of the reasons why corn and wheat, you know, shot up. And not only that, but when you're trading these commodities, you have to pay attention to crop production. Okay, so there are certain other elements that you have to be aware of. It's not as easy as trading indices, right? Not as easy as you're trading indices. And obviously you could trade currencies or you could trade currency pairs. Okay, move on. Rollover. A contract month is the month in which the futures contract expires. All of the E-mini stock index futures contracts trade on the March quarterly expiration cycle. That is March, June, September, and December. So now we're trading the September contracts. In September, and that is going to be mid-September, we are rolling to December contracts. So every 3 months, these contracts are going to roll. You don't have to remember the letter that is attached to the contract name, because if you're trading with a broker like TD Ameritrade or some other brokers, they roll your contract for you. So when you're looking at the chart, they have already rolled your chart. So you're not looking at an old chart with an contract with a former contract symbol. So, but just if you want to know, H is the March contract, M is the June. We're currently trading the U, so we switch from M to U, okay? And Z is December. Each contract is known by its ticker symbol, the contract month, and the year in which the contract is traded, right? So therefore, if you're trading, let's say a 2019 YM, right? You're going to have /YM, and then because U is the September expiration, you're going to have the U8. If you were trading June, it would have been YM M8. Okay, when we're gonna when we are going to roll into December, so at the end of the mid-September, okay, we are going to roll into the YMZU contract. Okay, so first it is the ticker symbol, then the contract month, and then the year in which it is traded. Okay, all right, we're gonna skip through this. All right, contract rollover. This is very important. Okay, this is very important. The roll occurs a week and a day before the expiration. Now remember, last Thursday at the end of the trading session, we had the roll, right? So we rolled from June to September, okay? Now, these contracts, these June contracts are going to expire. They're still trading right now, okay? They're still trading. Let me just go very quickly and see the volume. Okay, just give me 1 second here for this information to, okay. All right. So, well, now we have a relatively low volume because, you know, it's just like what? It's just 7 p.m. But we have 979 contracts traded right now, the second, and the June, still very much for June, 484, half the size. Okay, half the size. Should have been less, way less than that. I still see a lot of interest in June. Okay, and there are different prices, right? There are 4 days left until this contract expires. Let's say the NASDAQ expires, and they're trading it right now at 75.37. okay? And right now, NASDAQ is trading at 75.64. Okay, so there is a difference in price as well. But remember, it expires, okay? It always expires, and it expires the following Friday, right? And the roll is a week and a day before. All right. Okay. So day traders will trade the old contract even on the rollover day. Okay, and this is what we do. We did last week in the trading room. We traded it, and you're going to ask why. Why are we not switching to the new contract? Because all the volume and all the participation is into that old contract. Only after the rollover, volume is going to move into the next contract, right? Into the forward contract. And you know what? Like I said, you know, I'm going to watch this next expiration cycle, because this is very interesting to me that that June contract still has a lot of open interest. Okay, let's move on. Continuous contracts. Obviously, when we look at a chart, okay, we don't see just 3 months at a time. We have the whole price history. And that's very, very important. These are some of the expiration dates for 2019. This calendar is until 2020. So June 21st is when the expiration occurs. So this Friday. The next expiration is going to be September 20th, and then we have December 20th. This is how it displays on charts, and I like to have these horizontal lines on my charts, because if I don't know, if you forget that, you know, maybe you went on vacation, right? And you came from vacation, and you want to put a trade on in the indices, or even in the bonds, or, you know, crude, or whatever you may want to trade. What you want to see is what contract am I trading? Okay, so with TD Ameritrade and some other platforms out there, they do this job for you. So they display what contract you're trading and where the open interest has gone into. But you can see that there are continuous charts, right? So we don't only have 3 months of trading activity. For instance, here we have December. Okay, you can see the December. Okay, December right here. Okay, and that would be like, okay, so prior to December, we shouldn't have any data, right? Because we roll into December, and then we have January, February, March, right? And we would not display anything, you know, anything else. So that would not be a good read. So the fact that we have a continuous price action, right? A continuous history with price action, it allows us to read chart patterns. Okay, these are rollovers again, and these are the bonds right here that you see. All right, futures trading hours. Obviously, your broker can display. This is from my broker, from TD Ameritrade. I trade everything with TD. I'm not affiliated with them in any way, shape, or form. This is just what I trade, because I do swing trades. Sometimes I put some options. You know, sometimes, I don't know, maybe I put a currency trade every now and then. I like to trade because it's very versatile, very versatile. There are a lot of forex futures brokers out there that you could trade only forex futures with. Only futures with. They have very competitive commissions, et cetera, et cetera. But if you want to trade stocks down the line or anything else, or if you want to put let's say a trade in the VIX, okay, you may not do that. Because if you know, when you want to trade a stock, you will not have access to it, because they only trade futures. Okay, and your broker is going to have you know, a calendar with also with expirations, with rollovers, with trading hours, etc., etc. Okay, so these are the trading hours, and pay attention to these trading hours, because you have to know when the market opens, when the market closes, and et cetera, et cetera. Okay, metals, and they're different hours. Okay, now recommended day trading hours. I wanted to get to this point. So for futures indices, and this is for day trading. Obviously, for swing trading, you can take a position anytime. It could be overnight. Okay, it could be at 2 o'clock in the morning. Could be at 3 o'clock in the morning. Could be at 6 a.m. Could be at 10 a.m. Could be at 2 p.m. So you can take on swing position anytime. But for day trading, I trade the New York trading session. If you live in Europe, then yes, you can trade the London session as well. Okay, but day trade. Okay, day trade. Oftentimes when we look at the market, usually I have one last look at the market around 9:30 or 10 o'clock at night. Every day, every single day, I look at charts at that time. Okay, because I want to see how the Asian session is handling price and how the Asian session is handling the end of the London session and also the New York trading session. What do they make out of it? Are they influencing it in any way? Just so you know, Goldman Sachs, Chase, JP Morgan, they have offices in Asia. They have offices in London, and they execute trades. Sometimes, which is very interesting, if they have a large position that if they want to start initiating a big trade, they layer in little by little. They layer in the Asian session. They go a little bit stronger into the London session. And then they continue through the New York trading session. Have you noticed some patterns of dynamic buying into the Asian session, into the London session? How many times have we started the trading room up in the morning and the Dow was already up 400 points? Okay, that's not only algos, and that's not only the European session. It's also the US market that is buying through the London session and the Asian session. Okay, but because we live in the US and it's better for you and for your tranquility to narrow down your day trading hours. Just don't be chaotic. In trading, you have to be extremely organized. Even if this is a 24-hour market. If you continue trading 24 hours or even 18 hours a day and look at charts 18 hours a day, it's not going to help you in any way. You need to take time away from the market. Focus on one trading session, okay? If you want your trading session, and I like to focus in the morning, that is where the best trading opportunities are, okay? Very seldom cases, the afternoons let's say are trendy, or you have, good opportunities. I like to look for unique trading opportunities. And basically when we're going to go into strategies, into buys and sell strategies, breakouts or breakdowns and other strategies, in the afternoon, we have to look for a continuation, because if the market is going to break through lunch, or if it's going to consolidate at the highs through lunch, let's say in a bullish market, odds are that in the afternoon trading session, they may want to push the market higher. I have seen a lack of commitment in today's trading, okay? Lack of commitment on either side, bulls or bears, okay? Because they don't know what to make of the decision that is pending, right? They have no idea, okay? If you're trading metals, it is acceptable if you're a morning person and if you get up early, sometimes you can see gold starting to move at about 6:30 or 7 a.m. in the morning. If you're a very morning person, you can look at gold. There are some opportunities there. And then the open is at 8:15. Okay, the New York Open is at 8:15. Energy start trading at 9 a.m. Okay. And until 9 a.m., they trade on the overnight schedule. Bonds, 8:30 a.m., okay? And by the way, bonds, If you like to trade bonds, bonds make great moves. Not today, and I'm not expecting any movement tonight or like I said, but after FOMC, if you like to trade bonds, there are traders that are specialized in bonds. They don't trade anything else. They don't even look at the metals, energy, future indices. All they look at is bonds. Sometimes bonds have great moves from 8 o'clock into 8:45 or 9 o'clock. And at 9 o'clock, you can be done, okay? Sometimes. I like to look at bonds. Now, remember, they're a bit more pricier, okay? They're a bit more pricier, so you have to have, you know, a good risk amount for these bonds, right? But sometimes they're lining up some really tight setups, and if you're a morning person, this is something that I would watch if I were you. And I would watch bonds only based on a 5 or a 15-minute chart, okay? I would not go to a 1 or a 2 minute. All right, guys, it's it's almost 7:15. Let's take a quick 15-minute break. And in fact, you guys agree if we only take a 10-minute break? Do you guys agree on a 10-minute break instead of type of 1? If you guys need a longer break, just let me know. Okay, Ron. Okay. So, okay, so let's meet here. It's 7:12. Let's meet at 7:22. How about that? Okay, because we have a lot to talk about today. Awesome. I'll see you guys in 10 minutes. Welcome back, traders. It is 7:22. Let's continue. All right, now we're getting back in action with introduction to charting, intro to charting, candlestick language, and candlestick patterns. This is where it all begins. Okay. Quick introduction about charting. Charts are an essential tool for any trader who wishes to maximize earning potentials. You cannot ignore charting for one reason, and that's weekly, daily, and hourly. Thousands of institutional individual traders are committing billions of dollars to the market based on what their charts are telling them. Chart-based price action has been around for hundreds of years. Japanese rice traders are generally credited for the first developing a system of recording historical price patterns to predict future price movements. As early as the 14th century, the Japanese called these candlestick charts, and many of the patterns and nomenclatures that they developed is still used in Western markets today. Price charts were introduced into the Western markets at the end of the 19th century and really began to gain following when they started appearing in the financial newspapers of the time. Candlestick charts give you the ability to instantly see the trend of the markets, to see who's in charge, the bulls or the bears. Chart gives you the power to discern patterns and that have proven to be predictive of future price movements. Charts give you the ability to make confident decisions about where to enter and where to exit trades. And not only that, but they also forecast where the target levels are. Charts are the backbone of technical analysis, which allows you to use past price action to predict market reversals, stalls, and continuations. Candlesticks provide great visual suggestion that make reading price action way easier than other forms of price reading indicators. Trading with candlesticks allow traders to better understand the market breadth. Candlesticks offer better in-depth information than traditional bar charts. Where the high and the low are emphasized, candlesticks give the emphasis of the relationship between the close price and the open price. Traders who use candlesticks may more quickly identify different types of price action that tend to predict reversals or continuations in trends, one of the most difficult aspects in trading. Furthermore, combined with other technical analysis tools, candlestick patterns analysis can be a very useful way to select your entry points and your exit points. The body of the candle illustrates the difference between the open and the close price. The wicks, those are the extremities of the low or the high price, right, that are represented by those topping tails and those bottoming tails, right? They tell us where the buyers or the sellers took the price at within that period of time, right? Candlesticks also provide the story of what happened, right? We can see the footprints. We see like a bunch of green bars. We know that they have been buying, they have been accumulating. If we see a whole lot of red bars, they have been selling, right? So there has been a distribution happening. So candlesticks provide the story of what happened and what is likely going to happen. It is a picture of the past and potential future price action. And this is what we do every day in the trading room, right? We predict price action. We do a forecast. It allows us to forecast our next move. Okay? So basically the picture speaks to us in candlestick language. All right. Which brings us to the current slide. Each bar is composed of four elements, right? Which are the most important elements of the bar? The open, the high, the low, and the close. Okay? If the closing price is higher than the opening price of the previous candle, then the candlestick will be green. If instead the closing price is lower than the opening price of the previous candle, then the candlestick will be red. So when we look at a candlestick, right, this is the open. So this is where let's say the prior bar has closed right here. Okay, let me see if I could get here. Hold on just 1 second. Let me get an arrow. Okay, so let's see, here is where we have a candle. Okay, let me see if I could do this with a free form. And we had a candle right here. Okay, we had a candle right here. Okay, if this candle had a bottoming tail right here that corresponded with the open of the current candle, and if it is going to find buyers off of this open price, because this is when it first shifts, right? So let's say we're looking at a 5-minute candle, right? So this is a 5-minute right here. So within this 5-minute interval, let's make it with a wick right here. So it has a wick to the downside, it has a wick to the upside. Within this 5-minute interval, the price has been going up and down within this range, right? From the open, let's say it opened here, it went back up, okay? And this is a green candlestick. Now, if this is a red candlestick, it means that it opened here, okay? So red candlesticks open at the high, not at the high, open at the top, okay? So if the price pushed lower, okay, and it took the price and the price closed here, then if we had some buyers into this open here, then the candle is green. Does that make sense? Okay, let me just take these out. All right. It's a little harder to draw on this compared to the Webinato, but anyways, we'll get the hang of it. So basically the price opens here, okay? Opens here. And it pushes through all, and obviously it closes here. Oops, sorry about that. Okay. All right. But within this interval, from the open to the close, it had made a new low, but the price zipped back up and it went to a high. And then when it closed a bit lower. Okay. So basically, green candles are born at the open. And if we're getting buying influx, that creates the color green. Okay. It can take the price all the way to the high, but within, let's say, the last minute, before the close, the price is getting drawn back into the body, and therefore it closes right here. Okay, so it opens at the bottom and it closes right here at the top. Okay, now bear candles, and this is the these are the specifics for a bull candle. All right, bull candles, and this is a big thick bull candle. When we see such candles in the market, and when we see green candles, the next time when we see a bar starts forming, it will open here where my cursor is. Let me try to get that drawing done once again. Sorry about that. Okay. It's going to open here, right here, right? Because it closed. So it's going to open where it closed. And what's going to happen here is that if it's going to start going up, right, straight away, it's going to fill this candle right here. You see this candle. Now, if it opens and it pushes lower, but again, it finds buyers at these price levels here, then the candle is going to go higher, right? Every single time when we have a green candle, we can't expect follow through for green, okay? Once this high is challenged. So I always mention in the trading room that the close price is one of the most important elements that we need to look for, especially on the hourly charts, on the 30-minute charts, and also on the daily charts. Because if we have a candlestick, let me see if I can erase the mess here. If we have a candlestick that closes like so, very, very powerful candlestick that closes into the highs right here. The next candle that is going to open, the next candle that is going to start forming, if it takes the prior high, is going to issue a continuation. So most likely in a bullish market environment, it's going to continue to push higher. Okay, so there we have a continuation in price action. Now, the red candlestick, this is a bear's domain, right? It is the seller's domain. They always start generating at the highs, okay? They oscillate, they can have, and this is optional. They can have wicks or they can be full-bodied, okay? They can have wicks or they can be full-bodied. And we're going to talk about the specifics of each of these candlesticks. But if the price opens and then it decides to retrace higher a little bit, and then it retracts within the body and starts pushing in a forceful manner lower, this generates that red candle. Okay, so it means that this is the seller's domain. They have the upper hand. So when you see when you see a green candle, especially on higher time frames, watch for continuity to the upside. When you see a red candle, especially on a bit higher time frames, 15-minute, 1 hour, even 30-minute or 4 hour, okay, which is kind of like, I would say a very heavyweight time frame, the 4 hour. After the 4 hour, we have the daily, right? So these are the time frames that we're going to be watching. If this is a red candle on the 4 hour, and if it closes here, even if it doesn't have the wick, okay, but if it closes here, the next candle that is going to start forming, may have a lot of pressure to the upside, and therefore you can expect a much larger pullback, the beginning of a much larger pullback. So candlesticks can have wicks, or they may not have wicks. Okay, so it is fine if they have wicks. It is fine if they don't have the wicks. And we're going to learn about the meaning of candlesticks with wicks and a candlestick without wicks. Just to remember, the candlesticks that do not have the wicks are very powerful candlesticks, and that if the price is going to break the low, let's say of a red bar without a wick here, the movement to the downside is way more powerful than with a candle that has a wick lower, because this candle proved that it tested the low, but it zipped back up. You know what I mean? So it went lower, but it went back into the candle. Okay, same with the green. Okay, it went up and then it retracted. Okay, so the four most important elements on the candle are the open and the close, and the high and the low. And when we are discussing patterns, we are taking into consideration we're taking into consideration the candlestick, including the wicks. The wicks are very important. Now, there are some traders out there, and you know, throughout my trading career, I have heard a lot of things. A lot of traders that are looking at setups that do not include wicks. I think it is wrong, because I think that not only the open and the close are important elements of the candlestick, but also the high and the low. Okay, the high and the low, because remember, you need to trade over the high in order to start having a continuation higher, and therefore you are going to definitely have a continuation higher. And then if you trade below the lowest point of a bear candle, then definitely you can expect a continuation lower. Okay, so when the close is above the open, who wins? The bulls win, the buyers win, right? And they produce the color green. They are accumulating. They're buying. There is no doubt about it. It is their domain. They just want a piece of action, and they want to see the price higher. When the color and when the close is below the open, guess what? The sellers win. The bears win, producing the color red. So therefore, you have selling pressure coming into action, coming into the price. Every bar represents a battle that is fought between the two groups. It's a constant tug of war between the bulls and the bears, between the buyers and the sellers. And this is what we have on charts every day, right? Who is going to have the upper hand? Is it going to be a bullish day? Is it going to be a bearish day? Okay, and this we can tell by the colors of the candles. And like I said, we're going to get to that point. There is one candlestick on one chart that can definitely predict the next price action for the current price action for the next move. So how much each side wins is determined by how much green or red they produce. Does it have wicks? Is it a solid candle? Because solid candles are very powerful. They mean business. They're not wiggling around with bottoming tails and topping tails with wicks. No, they are serious. They mean business. All right, so let's go to our candlestick read. And this is basically everything this is what we need to remember when we're trading the markets, right? So when we're trading the markets, first off, we have to start from somewhere. And this is the first thing, reading the psychology behind each candlestick, right? Knowing that, a green candle means serious buying business, and knowing that a red candle means serious selling business, right? Because if we have a continuation for higher, and if we close, and remember, the bull candle always opens at the bottom, right? And buyers, what are buyers doing? They're buying at each and every single level and layer on its way up, thus pushing the price higher. Within an interval, whether this is a 1-minute candle or a 15-minute candle duration, if it closes at the high, those buyers mean business. They are telling us that the next candle that will open has an 85% incidence of a continuation higher. So now we know. We see a full candle, we see a big bodied full candle in our indices or in gold or in oil or whatever we're trading. That is serious buying action. Okay. Now, when this candle happens to be at support, that's going to be so much more powerful because it's a buy off the support level, right? But we're going to integrate that into technical analysis. Okay. So we open at the low, at the bottom, we push higher, and we close at the top. This is full control of power. Okay, this is the buyer's domain. Buyers are in full control, and they are into an accumulation phase. They're not thinking about anything else than except owning a piece of action. How about the red? The red opens at the high. It closes towards the bottom. It opens at the top and it closes at the bottom. If it has a full, thick body, no wicks. So remember, these two candlesticks do not have wicks. These two candles mean serious business, okay? When we have a big, thick red candle, it means that 85% of the time, the next candle that will open, is going to be red. We are going to continue the push lower, okay? We're going to continue the push lower. This is a seller's domain. Sellers are in full control, okay? They are power selling. This is distribution. They do not want to own. Usually you see these types of bars after a rally, whether a small rally or a big rally. There are always going to be bears that are either going to take profits, or you have fear in the market and you have distribution in the market, okay? Just like, remember when we topped in May, right? We topped in May. You know, it was like sell in May and go away, right? No, you're wrong. There are no listen, algos don't take vacation. This was probably valid like 25 years ago. Not today. We have a very active market. There's no such thing as, oh, you know what? The market in the summertime is dead. You know, sell in May and go away. Everybody's on vacation. You know, the big institutions, big institutional traders were going on vacation. There were no algos, et cetera, et cetera. No. Are you kidding me? Algos do not take vacation. Okay, they don't. So yes, there was some panic in the market and there was a retracement because we had an accelerated run from December until May, end of December, May, was it May 24th? We started the rally and basically we ended the rally into May. Okay, and then we started the pullback. So pretty much for the month of June, we had this pullback. Very difficult month to trade. Okay, by the way, very, very difficult May and very difficult June so far. Okay, very difficult June so far because we had the rotation that happened, okay, but happened on an extension. We're going to talk about that later. Okay, let's get back to chart. Let's get back to candlesticks. How about topping tails? Topping tails. Big candle with a topping tail and a small body, narrow body, very small body, whether green or red. Okay, these two candles suggest that sellers are taking control. This was once a green candle, full green. It opens here, right? It opens here. This is the high. And this is the close right here. This is the close, okay? This is the close right here, not here. It didn't close here. This is the high, okay? This is the high. This is the close right here, okay? Small body candle with a lot of selling pressure. Whenever you see this kind of candle, okay? If you see this kind of candle on a 5-minute chart, on a 15-minute chart, if you see it on a daily chart, if you see it on a 4-hour chart or a 30-minute chart, that means that you can expect profit taking into the market. And you can expect whether red or green, it doesn't really matter, okay? So both these candles are bearish, okay? And where sellers are taking control. Because here's the thing, the price opened here, okay? The price opened right here at the high. And for a brief moment, it went and formed a high. Remember, these are the highs, okay? These are the highs. These are the opens. And then again, it pushed lower, right? So it gave it all back. It gave it all back. It could not sustain the momentum for higher. It just came back down. And as you can see right here, it closed into the low, right? So the low and the close are the same. This is extremely bearish. When you see this type of candle, the next candle that opens below the low is going to be red. So you're going to expect selling pressure, okay? You can expect selling pressure. This is something that I look at every single day, okay? Do we have topping tails? Because if we have topping tails into resistance, that's going to mean 1, profit taking, 2, selling. Selling is underway. We see big, thick candles. We can expect continuation from the green higher and from the red lower. Okay. How about bottoming tails? Bottoming tails. Oftentimes you're going to hear me in the trading room saying, price is getting a lift, right? They're getting a lift. So what happens is, remember that the green candles open at the body of the green from this low, right? Not low, from this bottom, right? So they get the lift. Within the interval, if this is, let's say, a 2-minute candle, within the 2-minute interval, the price was all over the place. The price was here at the low. It set a low because it zipped down, and then it was sucked back up, and then it closed at the high. When you see a candlestick, whether red or green, that has a big bottoming tail, it means that the buyers are starting to come in, and they're pushing the price higher. They're pushing the price higher. They want the price higher. There is no selling here, okay? So we have to wait for what? Continuation over this high right here, continuation for higher. Over this high of the red candle, continuation higher. So regardless of the color of the candle, when you have bottoming tails, you can expect a push higher if the price will trade above the high. Notice the nuance here, above the high. So if it's at the same level with this top right here, or with this top right here on the red, it means that it's not ready yet to take the high. You need to see a print of at least 1 to 2 or 3 ticks above the high to confirm that it is ready to push higher. Remember that in the trading room, I say, okay, the S&P needs 63 to push higher. Or NASDAQ needs, I don't know, 74 to start pushing higher. We need to see a print of 62, let's say, in YM. This is what I'm looking at. I'm looking at these candles. I want to see the price close above the prior candle high, or I want to see it above a cluster. Because let's face it, in a sideways market, you're not going to have like textbook setups. Okay, you're not going to have textbook setups, but you're going to have these candlesticks present. Does that make sense? All right. So in a normal continuation pattern, okay, or even on support or resistance, you can have the following normal bull bear that is normal buying and normal selling. okay? Normal buying and normal selling. And oftentimes, most of the candles that you are going to see on the charts are going to carry some kind of wick. Large wicks are also a good representation of algorithmic trading. The wider the wicks, the whippier the wicks, more algos were trading into that region, into that price parameter. Now, dojis. This is a doji, which is a neutral, right, candle. It doesn't have any color, but these two are also dojis. Small, narrow body green, small, narrow body red. This is normal bull bear buying and selling. However, they have this shape because this candle either forms at resistance or at support, or if it's not trading into support or resistance and it's losing its pressure, right? Because you see a narrow body. You don't see a full body, full commitment saying, yeah, I'm going higher. Like that determination. When you see a big full green candle, you have conviction to go long, right? You have conviction to go long. You know that technical analysis and candlestick language is pointing you to a continuation higher or to a continuation lower. You're approaching the decision point right here. You're approaching a decision point. Above the high, you have a continuation higher. Below the low, you're going to enter retracement, okay? Or the bear, right? Below the low, you're continuing lower. Above the high, possibly pop higher, okay? In either case, whenever you see these narrow body candles that carry quite impressive wicks, it means that that is a decision. Most likely, if you see, let's say, a red candle here, or you see red, 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 three red bars or 4 red bars, etc., and then all of a sudden you see this bar with a little bit of green here, over the high, you buy, okay? But if it's into support, over the high, you buy. And I'm going to show you some examples in just a second. There are some candlesticks where the color has disappeared entirely, okay? And this means game over, either for the bears or the bulls, right? These candles mean serious business. It's not oftentimes that we see them on charts, but these candles, and in fact, all these 3 candlesticks right here reveal and have a tremendous importance for our charts, especially if these candlesticks, these 3 candlesticks here, are onto the 1 hour, the 4 hour, the daily, or the weekly. Oh, of course, the monthly, absolutely. They are carrying tons of responsibilities. Why? Because this is decision phase, and especially this one right here, the neutral, this is decision phase. If we had an extreme rally, right, or if we had big follow through to the upside, bulls or bears cannot continue to run for extended periods of time. They need to rest, right? So when the bulls are in charge, you're going to see 3, 5, 8 candlesticks that are pushing higher depending on the time frame. And then all of a sudden, the bulls need to take a break. They cannot handle it. They're exhausted, right? They're exhausted. They're running into overbought territories, right? And they need to take a decision. They go like, hey man, you know, are we gonna push further or are we gonna wait for FOMC? Okay, this is kind of like expecting for the FOMC to happen. Okay, so definitely if you trade above, if the decision is made, and if the bulls are gonna trade above the high, well, hello, yeah, we're gonna continue higher, and the bulls get ready, they drink some water, and they go like, okay, let's get started, okay? And then they run again, 1, 2, 3, 4, 5, 6, 7 candlesticks, right? And they start running again. It's another marathon for them, right? It's a 3K or a 5K, etc. So it's another marathon for them. They're pushing higher again. How about if we break the low? If this is into a high, okay, if this is into a high, maybe it's time for a pullback. This is the first sign that your index or commodity or whatever you're trading, even if you're trading stocks, this is the sign that if the price is going to challenge the prior low, this low right here, okay, if this candle that is going to start forming right now opens here where I have my cursor, and it's going to run down and take out this low by 1 tick or 2 ticks or 3 ticks, and if it constant presses against the low, by all means, the price is going to go lower. Okay, it's going to go lower. Okay, how about this candle with a huge topping tail? Okay, huge candle. The bears are getting full control here. They're pressing so hard. They're pressing so hard. They want the price lower so bad. This candle does not stand a chance in color. Okay, does not stand a chance in color, because it opens, it zips up, and it gets pressed down violently. They just press it so hard, so fast, that this candle never stands a chance to complete in any color. Okay, same thing for the bulls. The bulls are taking control so fast in price. They're pushing the price so fast. They open, they zip down, and immediately, and this is also, all these 3 candlesticks, and especially these 2 right here, along with this, okay, these are a lot of times algos are to blame for, and especially these 2 right here with the big topping tail, no color, and the big bottoming tail, no color. Because the price went down and it zipped back up. God forbid you have a stop right here in the middle from a prior formation, because this could be the wick that is going to take you out, and then the price is going to zip back up. Okay, that's what stops are for. So neutral candlestick, it means slow down in the momentum. So remember, the bulls are charging, going fast, but all of a sudden they can't run anymore, right? Okay, so they need to take a break. This is their break. Okay, this is their break. Or bears are in charge, and the bears start pushing lower, and they keep on going lower, fear. Okay, but all of a sudden they run out of steam, and they form this doji, which means decision time. Okay, decision time. They need to take a break. Say, hey, we need a break. Okay, what now? Okay, they take a break. Sometimes they move lower. They break below the low of this decision bar. This is the decision bar. And we have this bar right now in the markets on the weekly charts. Last week's candles are dojis in all the indices. Okay, this is decision time. And it's coming right into FOMC. Bottoming tails. You can see right here the bottoming tails, right? You see the bottoming tail. Buyers are controlling the area from the open to the close. The bottoming tail is the candlestick pattern which marks the end of a downward move, right? So you had bam, 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 lower, right? In stages. You had a red bar, followed by a red bar, followed by a red bar, and all of a sudden you get a lift in price. You probably hit some kind of support level, and you get a lift in price. So after several consecutive candles with large red bodies, price tries to make another large red candle but fails. The price pulls back before the end of the last candle, leaving a large wick or tail at the bottom of the candle. Zips right up. So what do you think is going to happen here? What do you think is going to happen here? So when the next candle is going to start generating, obviously it's going to open here at the same level, right, with the close. It prints 1 or 2 ticks above the prior candle high, what do you think is going to happen? It's going to move up. Okay, it's going to move up. And it's going to start forming a buy setup. We're going to talk about that. How about topping tails? Sellers are controlling the area from the open to the close. Bears. A topping tail is a candlestick pattern which marks the end of an upward move after several consecutive candles with large green bodies. Price tries to make another large green candle, but the price pulls back so fast before the end of the last candle, leaving us with a really large wick at the top of the candle, right? So this is selling pressure. You don't need to have a color. If you have that big, large wick and the flat, close, right? You got open and the close in the same spot, right? Then the candle that starts generating here, if it prints 1 to 2 or 3 ticks below this prior low, guess what is going to happen? It's going to push the price lower. All right, this is a representation of the most bullish to the weakening of control. All right, first candles, guys, bullish, right? So what we have learned is that we're getting a thick, big bar, green bar. Odds are 85% of the time, we take out the prior green bar. We're moving where? Higher. How about the red bar? Selling, selling, selling pressure, fear. Nobody wants to hold on to any contracts at this point. If we break below the low of this candle, guess what's going to happen? We're going to follow through lower. How about if we have a bottoming tail? Does it really matter if it is green or if it is red right here? Not really, because what truly matters is that bottoming tail. It means that the price is getting a lift, okay? It's getting, the price is being pushed higher, right? Whether we have bulls or bears, right? They're losing, and even the bears, obviously, they're losing control over the red because the bulls are coming and they're pushing the price higher. In this case, in the green one, yeah, they're coming so fast into this game. They're buying so fast, they're leaving a wick. Okay, how about topping tails? Topping tails, they're hitting some kind of resistance, right? Obviously something is happening at that level. There's a level there where the price is getting rejected. They don't like those highs and the price gets knocked back down into the body. Okay, so we can notice some selling pressure coming in, whether we have a green body or a red body. Here's the green body, here's the red body. So it means that bears are still in control here. They're still in power, but they're getting a forceful move to the downside. And here we still have a bullish candle because we still have a little bit of color green, but the control is weakening, right? So they're pulling the price down. And again, we trade below the prior low, 1 to 3 ticks or so. We're gonna print lower prices. We're going lower. And then we have the neutral price action, which means decision. Remember, doji, decision. Whether it has no color at all or whether it has a little bit of color, that's still decision, right? So bulls and bears are meeting at the negotiating table to go like, okay, where are we gonna go now? We need to decide, are we gonna go up or are we gonna go down? So that's the true meaning of that tug of war, okay? So that's the true meaning of that tug of war. They still don't know in which way, and they're pulling the price around in each direction. And then we have the normal price action. So all throughout charts, you're going to be seeing green and red with wicks, okay? Now, I just want to show you the definition. Now, I don't want you guys to remember the rising sun or the bearish engulfing or the Rami or whatever it is. What is truly important is that you remember the significance behind the candlestick. But I just wanted to put this slide right here because they have different meaning. And this is something that I look within price action, okay? Now, I'm gonna start with my absolute favorite, which is the Harami right here. So there's a neutral price, there's neutral pattern, okay? So we have a prior a green big bar, or it could be a red bar. It truly doesn't matter, okay? It truly doesn't matter. You could have a red bar here and a green bar within, or you can have a green bar like it is here with the red bar within. What this matters is that the price of the second candle is under the control of the prior high and the prior low, okay? What this means is that you're going to pay attention to this candle as opposed to this candle, because we know that within this candle, we only needed to print above this high in order to start continuing higher, right? But here's a really nice nuance that we can apply here, and that is if we have an inside bar, I call this an inside bar, right? If we have this an inside bar, guess what? If we trade above the prior high right here, we're bullish and we're going to continue higher, and we can use this stop versus this low right here. Isn't this wonderful? So if we have an inside bar, this is very typical for stops. You're going to find this pattern in a lot of stocks, okay? So you're going to have, this is called an inside bar. Usually these patterns are incredibly powerful if they happen on a very high time frame, such as the daily or the weekly or even the monthly charts, okay? They should be watched on these higher time frame charts. They don't really have any kind of significance when they're on the 1 minute or 2 minute or even on the 5 minute, okay? You have to have a very defined time frame that is definitely going to influence price at this point. So you have a big candle, we have a narrow. So what this means is that the volatility created a high price and a low price right here. And then you have the calibration within this candle, and you can see now that you have a smaller range, right? So let's say this is a 60-minute price action activity, and this is the other 60-minute price action activity. So it has, you can see that the price action has compacted, right? Has retracted from the high and the low. So therefore, on the next setup, you can consider this as a trigger for higher, and you could put your stop below this candle low as opposed to this low right here, okay? Now, I'm going to start from the beginning now with the bullish engulfing, bullish patterns where there is a lot of momentum in favor of price rising, right? Because I call this the slingshot, and oftentimes due to volatility, you are going to see that the price is not really going to get you're not going to really get a big fill, a big, thick green candle, but what you're going to see is that a big top bottoming tail, right? The price is going to do a sling and then shoot higher, okay? This is very bullish right here. So remember, you have the retracement that happened, green, a red bar, red, and then you have the price that opened here. It went lower, it went lower, and then it snapped back up, okay? So this is I call this the slingshot, and oftentimes, since last year, you're going to see this on charts, and we had this, even today, we had the, let me show you the slingshot, okay? Let me show you the slingshot. Let me just get a marker. Let's see if I can do this. All right. Okay. This is support right here. Okay. This is support. Notice the slingshot. Okay. This is the slingshot right here. You see it? This is the slingshot because the support, it pulled in and then it went back up. And this is resistance right here, okay? So we had the slingshot before the continuation higher, okay? We haven't had a slingshot. Oh, here it is. Slingshot. Support. And these are algo generated. Okay, this is from today's price chart. Notice the slingshot. This support needed to hold right here. Okay, this support right here needed to hold. It didn't hold. It was formed by this prior low, right? And look at the slingshot right here. You see it? You see this wick? Now pay attention. Pay attention. Hold on just one second. Okay, pay attention to this candle right here. Let me just get my mouse back. What is this candle right here, guys? What is this candle called right here? Can you type it in the room, please? Can you type it in the room? Wick, wick. Doji, exactly. Decision time, right? So it means business. If it goes above the high, where is it going to go? Higher. If it goes below the low, most likely it's going to continue lower. So it reached the decision. And notice that the decision came right into support. See how it shook everybody out of the trade before continuing higher? It shook everybody out of the trade. And here's what happened. This candle closed here. It opened here, pushed lower. It did a peak up below, you know, kind of like looking, are there any, is there anybody else that wants to short at this level? Quickly, the answer came and said no. And they go like blip and back continuation higher. Okay, back continuation higher. Now there's a bearish engulfing, right? Bearish pattern where there is a lot of momentum in favor of price falling. So here you have a smaller sized green candle, and then you have a big, thick red candle. Big, thick red candle. So when you look at the candlestick, you don't need to remember the names, okay? Don't remember the names. Just pay attention. Pay attention to your chart structure, okay? And all you have to look at, big bar, right? Big bar. So usually what happens is that if we trade above the prior high, we're going to continue higher. These are decision bars. So here's what's going to happen. Whether you're trading this bullish engulfing or bearish engulfing, you trade above the high. And guess what? Your stop is going to be below this prior low here, okay? If this is the pivot right here. What happens is that you're going to get in long. It's going to stop you out. This is the time when you have to look, and then you have an alternate entry opportunity if you break below this low, okay? Or if the price, if you're lucky enough for the price to fluctuate back into this prior low, this is your short. But then again, your stop is going to have to be the widest candle right here. We're going to talk more about, you know, entry stops. This is just an illustration. Okay. Okay. Dark cloud covered. It's a bearish pattern where price acted like it was continuing upwards, but it reversed, right? Typical. It triggers and it's coming back. But here's the thing. As long as the stop is below the prior candle low, and remember that we're talking about candlesticks, but when you place stops, you place them under pivots. You don't place them anywhere else, okay? You don't place them under just under candles, not unless you're doing a candle trail. Anyways, so you can see that as long as the price, even if the candle is red, as long as it's not taking out the prior low, you're still engaged into a bullish move and you're still locked into the trade. Because you're seeing red does not give you the right to say, hey, you know what, I'm going to take my loss earlier rather than seeing the test of the low. No, in this case, you place your stop and you're hands off. Just go for a walk, go to the kitchen, grab some coffee, some water, and then come back. Okay, if you're still in the trade, that's fine. The pattern is working because there is an incidence of the pattern not working. Okay, now we're dealing with the highest odds, and when we trade, we put our highest odds on in our favor, right? But in some cases, things are not working out, and you know the inevitable happens. But this is why we play with stops, right? Okay, we have rising sun. This is a bullish pattern where price looked like it was going to continue down, but then it zipped back up. This is a shake, pretty much like a shakeout. See? So instead, you can see it right here, pinching lower before pushing higher. And then again, we have two lows high. This is very, these two candles right here mean serious business. It is a pattern. The pattern could be bullish or bearish depending on the context. And same with the two lows, high close, or two highs, low close. Okay. But what matters is that it has an equal support zone. So it's bouncing over, it's bouncing on some type of support. Okay. It's bouncing off a support zone, or the price itself is finding support at that point, at that price point. Okay. Now, two highs, low close. What matters is that we're hitting some kind of resistance, or even if we do not have resistance, we are establishing resistance. And this often happens, this pattern and this pattern with the I call it a double bottom or the double top candle. It means that we're either into support or resistance, or we're hitting a reversal time, which is much more powerful and is driving the price with either higher or lower. Then we have the hammer or the pin. Okay, some call it an inverse hammer or a hammer or whatever you want to call it. I call it topping tail or bottoming tail candle. But if you read books or if you listen on CNBC or Bloomberg or whatever, and they bring it up, just know that it has two other names, either a hammer or a pin, and signals a reversal when the wick sticks out way past the surrounding prices, right? Price tried to go higher, but it was rejected. And then the doji, which is a neutral pattern, which could have different meaning based on the context. Remember, you have an accelerated run up and you have a doji. Okay, I had a friend that used to call it the Death Star. So it's like, oops, that's the Death Star right there. And then that meant that if we close below the low, we're more likely going to come in, and you could start shorting. But very, very carefully off of that high. Or if you're in a downtrend and you have sell, and you have the doji, then if you have the doji at that point, then it's more likely to continue to go higher, right? You have a reversal at that point. That doji is expressing a reversal. Guys, this is it for tonight. I think I want you guys to digest these candles. Okay, and then when we come in tomorrow, we're going to talk about patterns. Now, remember, we just tapped into candlesticks, right? So the takeaway, the wrap up from today is that when you see a big red candle, and let's go to charts, okay? So the takeaway is that if you see a big red candle with no wicks into resistance, what are you going to do? You're going to see selling pressure come underway, right? See the selling pressure here in Russell? Red, doji. Why is the doji here? Okay, we're going to learn in 2 days from today about support zones, right? Moving averages are dynamic support or resistance areas, right? And we have the prior highs right here, which mark resistance that translate into further price action into support. Okay, I'm going to show you an easy way to do this on Friday, how you can read the charts and how you can mark the charts for your analysis, so you can simplify your process. It's going to be, I promise you, on Friday you're going to love it. But we have decisions. So we have big bar down, red bar, right into the 20 SMA. So obviously it had no reaction here into the 10 EMA. We didn't get any kind of rotation, any kind of pull into the upper side, but we had a continuation lower. It hit the 20 SMA and it stalled because the 20 SMA, especially on the 15, on the 1 hour, on the 4 hour, on the daily, weekly, and monthly, these dynamic support zones are very potent. So with that being said, if we had a break above the high, so if the price would have traded above 1540, what do you think would have happened? We would have zipped higher because this is decision point. But we decided to go lower, so we printed a lower price and continued lower, right? We zipped back up. Notice where we did zip back up. Look at the next 15 minute. We pulled in. We found support into prior support from the morning session. And what did we do here? Zipped back up and started to push a little bit higher, okay? So bottoming tail, guys, what do we have on bottoming tails? Now, for bottoming tails, it is very, very important if we trade above the high, means that we're trading higher. And in this context right here in Russell, and it doesn't really matter which index or a commodity or even a stock or ETF, okay? What matters is the low and the high. And as long as you're trading within the same parameters, and you can see here that we have traded ever so slightly above this 15-minute high. Notice the 15-minute high at 38.8. Well, we finally made it into a high here of 39.3, which means that we're maintaining still the upward structure on the 15-minute bottoming tail, and we're trying to push a little higher. Does that make sense, guys? Let me show you some dojis, okay, on the weekly. All right, on the weekly. You can see my alerts right here because these dojis are so important, right? We break above the high, we're going to continue higher. We break below the low, we're going to retract some more lower, and it's possible even to go to 1450 again, right? But because we're trading in the upper half of this channel, you can see it right here, and it's upper hand. This is 1 week activity right here. 1 week of trading activity, right? And you can see that still very early. This is Monday, right? And we're trading in the upper half. If the overnight trading session is going to trade over 1544, it means that we're going to be issuing a continuation, and the decision has been made, right? And we're going to push higher. Same thing for the E-mini S&P. That's why I called it today as a swing long. Okay? Look at this beautiful doji right here. Look at this beautiful doji. Okay? Doji 29.14.25. Oops. Hold on, let me just regain my mouse. All right, the high, if we break above this high right here, above 29, what's the high? I'm sorry, the high is 29.11.5. So if we print at 29.12, okay, if we print at 29.12 tonight, we're gonna start moving higher, okay? We're gonna start moving higher. Now, I have some alerts here for some targets, but we're gonna start moving higher. If tonight we're not going to hold this lower, remember I have my stop into the 58, so I'm giving it a little bit of room. Remember, I'm in this trade with micros, okay? I love the micros. I can position size. And again, the whole point of using micros is that it gives you the flexibility if the price is going to come back in, and if it's going to rotate on a smaller time frame, on a 4 hour, for instance, or even on the 1 hour, I have the flexibility to add in, right? More contracts. I can even lift my stop if I want to, if the chart pattern tells me that, yes, I could get that lift, okay, in my stop. And I could take profits. I could scale out of the trade. And then if it's hitting resistance again, I sell it, right? I sell part of it. I don't sell the entire position, but as it, so I'm playing around. And therefore, when I got it here at very close to the 2900, if it retracts a little lower, guess what? If I buy, I'm gonna bring my average down. Okay, so it's a whole workout. Let's say for price. Okay, but this is a doji. This is decision point, and this is what we want right now. We want to see a print of 29.12. We're off to the races. All right. Let me know if you have any questions. This is a wrap for today. Remember, the trading session was recorded. The manual will be sent out on Friday, and the recordings will be sent out either on Saturday or Sunday because we need to transfer them to Vineo, and we will send you the links. And this is way better than what we had with Webinato because now you can actually download them to your. You have the option to download them to your computer if you do not want to watch them online. Okay, so you have the option to watch them online or to download them, whatever your preference is. All right, guys, this is a wrap. Let me know if you have any questions. Hey, Denise, say hi to Joycey for me. Glad you could make it. All right, guys, I'll see you tomorrow, same time, 6 o'clock. Have a great rest of the night. Remember, don't be very aggressive trading tonight because we do have FOMC. It is a very busy week. We have option expiration at the end, so it's going to be really, really hard. Keith, what time frame would you say is more critical to the bottoming or topping tail? I think the 1 hour charts, yes, 60-minute daily, even the 4 hour charts. Yeah, these are very, very strong, but you can watch them. If you're day trading, you can watch them on the 15-minute as well. More predictive on higher time frames for sure. 1 hour, 4 hour, very strong, and especially daily, weekly, obviously. Very, very, very strong. Awesome. Anyone else? Any questions? All right, guys, this is a wrap. Have a good night, and I will see you tomorrow.